Have you ever wondered, is the stock market overvalued, undervalued, or priced just about right? If determining the current value of the stock market is a question that you have, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. As I continue with this series on market valuation, this is part 6. And I believe there will be 7 parts when I finish with this. But what we're trying to do is use tools to determine, is the stock market overvalued, meaning expensive? Is the stock market undervalued, meaning that it's cheap? Or is the stock market fairly valued or just about right? The website that I'm using to get a lot of this information from is called Current Market Valuation. And here's their web address. It's currentmarketvaluation.com. This site is freely available. You don't have to provide an email address or sign up. It doesn't cost you anything to access this information, but it's a very useful website that we can use to get a big picture view of the current valuation of the stock market. In this video, I will be looking at interest rates and how they relate to the stock market. Some investors like to buy bonds in order to receive interest payments. What you do is you put up a sum of money, let's say $10,000, for a certain period of time. It could be 10 years. Well, what happens is you're basically loaning an entity money. A lot of times that would be to the government. You loan them $10,000 for 10 years. At the end of that 10 years, you not only get your $10,000 back, but during that period of time, you receive interest. A lot of investors will do this when they're looking to retire. This is seen as a less risky strategy to use, and we call that risk off, because bonds are considered to be less risky than stocks. A lot of investors will spend their lives using the stock market to gain their wealth, and then when it comes time to retire and now they want to produce income from that wealth, they take it from the stock market and put it into the bond market. Because these bonds are backed by the government, they're considered to be very risk-free. And even though their interest rate is very low, you're not putting your money at a lot of risk at that point. However, in the US, interest rates are currently at or near all-time lows. If you've looked at the interest rates lately, you know that they're very low and they're well below inflation. So if you invest in bonds right now, you're actually losing money if you compare it to the inflation rate. When this happens, that makes bonds less attractive, and people need some kind of a return somehow. They have a chunk of change where normally they would get into bonds. Well, that's really not paying anything. In fact, you're losing money. So they take that money and they put it back into the stock market to try to get a more attractive return. In order to obtain these higher returns, investors will buy stocks, and that is considered to be riskier. And we call that risk on. So when you're in the stock market, it's risk on. When it's in the bond market, it's risk off. And on some of the financial channels, you may hear that today. If bonds are up and stocks are down, they'll call that risk off. If the opposite is true, they'll call that risk on. And this can change on a day-to-day basis, but don't let that fool you. You probably want to take a bigger picture look at things and say, what am I overall for the long term right now? Am I risk on or risk off? Am I in bonds or am I in stocks? So buying stocks then helps keep stock prices at current levels as well as push prices higher. If you have a lot of money out there from stimulus and monetary policy, yes, it initially starts out in the bond market, but the interest rates are not very attractive, so they take that out of the bond market and put it into the stock market. Or if you receive some kind of a stimulus check and you decide you want to invest that, instead of buying bonds, you'll put that into the stock market as well. And as prices fall, you look to buy the dips, and that helps keep prices at current high levels. Or if a lot of buying happens, that pushes prices even higher. So that is one of the reasons why the stock market has really held up well in this COVID-19 pandemic era, because a lot of money is flowing into the stock market to buy, and that pushes prices higher, or at least keeps them at current levels. As of September 10th, the model that we're going to look at in this video, which is based on interest rates, current market valuation has it rated as fairly valued. Some other measurements that we look at say that the stock market is overvalued. This measurement says we are fairly valued, and I'll talk about that throughout this video and how they come to that conclusion. Is there a conflict here? If you've watched any of my other videos, I talk about how interest rates and the stock market can go up together, and I'll show a chart of that here in just a moment. Current market valuation, their research, as well as some other research, suggests that as interest rates go up, stock prices go down. And although both can be true, we need to keep that in mind. There are certain environments where the stock market can go up as interest rates go up, and there's other times when interest rates going up can push stock prices down. So we have to ask a question. Does interest rates rising or falling impact stock prices? Research that I've done, and the name of my program is the SPX Investing Program, it shows that stocks tend to rise with interest rates, especially when you're looking at a longer-term time horizon. Other research indicates that stock prices tend to fall as interest rates rise, and vice versa. If interest rates are falling, then stock prices will rise. Both are correct, as I stated just a moment ago. There are different environments where we have to look at things in just a little different way. The environment then will dictate the relationship. Think about this, and it makes sense. If interest rates are rising, that means that it costs more to borrow money. If it's more expensive to borrow money, that's less profits for companies that do go out and borrow money. So we would see their stock prices decline because their earnings are less, and that makes sense. You can make a logical argument for that. Think of it the other way, though. If we have an economy that's growing and stock prices are going up, in order to keep control of inflation, the Federal Reserve will raise interest rates, which then flows through the entire interest rate environment, and interest rates will go up. Yet the economy continues to grow and the stock market continues to advance. So there are times when you can see stock prices going up while interest rates are going up. But there are other times when interest rates going up can have an impact on the bottom line of a company, and stock prices will go down because their earnings go down. There are periods when stocks and bonds move in tandem with each other, which means they go in the same direction. If bonds are going up and stocks are going up at the same time, there are other times when they are inversely correlated. When bonds go up, stocks go down, and vice versa. One of the parts of intermarket analysis is to understand what's going on at any given time and then evaluate things accordingly. What you see now is a chart that I've used in other videos, which talks about the Fed funds rate and stock prices. I pick up in this chart in the 1980s because the 1970s was really crazy. We just had hyperinflation or stagflation during that time and really no economic growth. Well, we got things under control back into the 1980s. We can see on the chart where the Fed was raising interest rates during that time. And even though it's a little hard to see because this chart is a little wacky since prices have gone so high, but as we were coming up out of the 1987 crash, interest rates were being raised and the stock market was also going up. And there was another period of time when they were lowering interest rates and stock prices continued to advance overall. Going into the mid-90s, which is when we started to see the stock market really take off. It was the time, I think it was 1994, when the Dow went over 4,000 for the first time. Well, during that time, they were raising interest rates and the stock market was going up too. Then as we get into the mid to late 90s, interest rates were really going flat during that time, but stock prices continued to advance. Then we get into the late 90s, where you have the dot-com boom and eventual bust, where interest rates were going up during that time, but the stock market was just really going up strong. Then everything switched when we had the dot-com bust. Then eventually 9/11 happened. That really hurt the economy a lot, so they really lowered interest rates during that time, and stock prices went down. So you see interest rates going down and stock prices going down. Finally, in about 2003 into 2004, we leveled off with interest rates. Stock prices started to recover again. We were doing pretty well up until 2007, when then we were hit with the housing crisis and the whole financial meltdown that occurred in 2008 into 2009. They really lowered interest rates. Stock prices, of course, fell. But then you get to something that's very interesting. Starting in about 2009 and through 2014 into 2015, you had a very interesting thing happen. You had quantitative easing. And I counted 4 programs, QE 1, 2, 3, and 4, which is something the Fed said they would never do, but now it seems to be a way of life, where they create money out of thin air because we have a fiat currency. Well, how is that money introduced into the economy? They take that money and they buy bonds. Well, when you buy bonds, that makes bond prices go up, which makes interest rates go down. And then a lot of that money, too, comes out of the bond market and then goes into the stock market. And for a long period of time, well into 2015, we had interest rates at zero. The stock market was really rebounding nicely, but interest rates were flat. And then finally, in 2015, was when the Fed decided to raise interest rates for the first time, and you would have thought it was Armageddon. Then from 2016 up until the start of the pandemic, you saw a more normal relationship during that time. Stock prices are advancing, interest rates are advancing at the same time. Then we had the COVID plunge. The Fed immediately threw interest rates down to zero. Stocks initially crashed, but then have been able to bounce up out of that. And interest rates remain at zero as I record this, but yet the stock market is hitting all-time highs. It's a very strange environment right now, and it's been strange for a while and will probably continue to be strange into the future. We see a lot more quantitative easing going on. That seems to be more of the new normal now. So what I get from this chart basically takes both scenarios and say they can be true. There are times when interest rates coming down helps stock prices climb, and there are other times when interest rates are going up and stock prices are going up at the same time. Here's the chart that they use at current market valuation. I'll go through this and then break down some of the different parts, where we look at the real value of the S&P 500 relative to interest rates. And this is as of September 10th, 2021, where we closed at 44.59. It's a little hard to see because of this box, but way over on the right-hand side, the current price of the S&P 500 is 2.5 standard deviations above the trend line. And if you want to understand that, look at my other video where I talk about the S&P 500 mean reversion model. Also looking at this chart, we can see way over on the right-hand side, the 10-year Treasury rate is about 1.3%, which is 1.6 standard deviations below the trend line. And what they do for this model is they take the stock market value and the interest rate value and they put them into a composite to come up with what you see here is this purple line. So when you take a composite or a sum of the two, it suggests that the S&P 500 is fairly priced when compared to interest rates. But they also give a caveat here saying that we're getting really near that +1 standard deviation. If we go above that, that means that we are getting to an overvalued situation. When this really becomes an issue is if we go above the +2 standard deviation. So what I want to do is take parts of this chart and just break them down one piece at a time. The chart that you see now is the 10-year interest rate. This is the 10-year bond going back all the way into the 1960s. What we're focused on the most is way over on the right-hand side to show just how low interest rates are right now. Most countries will use the 10-year bond as a benchmark. So we can compare the 10-year yield in the US with that in Germany or Japan or other countries, and this gives us more of an apples to apples comparison. I take that same chart over on the left-hand side, and now we have at 6%, which is the historical average for interest rates over the long period of time. We can see by looking at this chart, we look at where interest rates are right now compared to their average, and interest rates are very, very low. Looking over on the right-hand side, we have the current value of the S&P 500 compared to its average over time. And even though that dotted line, which is the average, is going up, they're really far from each other. The dotted line acts like a magnet. Something is going to have to happen. Either that dotted line is going to have to go up a lot more, a lot faster, or the blue line is going to have to come down, because prices have a tendency to go back to their historical average. This is the same chart, but now we plot some standard deviations. How far away are we from the historical average? On the left-hand side, it just shows where the 10-year Treasury interest rate is way below its historical value of at about 6%. And we are currently at 1.8 standard deviations below the average. Over on the right-hand side, we can see that we are well above 2 standard deviations of the current price of the S&P 500. So stock prices are very, very high. Interest rates are very, very low. Now, looking at this model chart again, what they do is they take both of those together, the stock prices and the interest rates, combine them into the purple line. And that's where we get the composite for this particular model. We want to keep an eye on this, because if stock prices continue to go up and interest rates continue to go down, we may go above 1 standard deviation the next time this model is looked at. So what are the conclusions that we can take from this? And my conclusions are pretty much the same in all of the videos that I've been doing in this series. The S&P 500 value relative to the interest rate model posted by current market valuation is fairly valued, but it's getting close to being overvalued. Not extremely overvalued, but overvalued. Other measurements that we use show that the S&P 500 is overvalued. Stock prices are getting just way out of hand compared to what they should be historically. Does this mean that you freak out right now? Not necessarily. And in all my videos I've been saying this, what we need to do is come up with a plan. Something is going to have to give. Earnings need to go up to justify these stock prices. Interest rates need to go up to justify these stock prices, or prices need to come down. And if they come down, they may come down hard and fast. So you need to be ready. What are you going to do if things do change, if they do turn? We're in an uptrend overall in the S&P 500. What happens if we change to a downtrend? What are you going to do? You need to be thinking about that now, so that if things do change, you'll know what to do, and you're not just panicking and trying to make things up as they happen, wondering, oh my gosh, I'm seeing my portfolio decrease, or I'm seeing earnings that I really enjoyed going away. What are you going to do if things really do change? That's the plan that needs to be developed. If other measurement tools that we use to study the trend, for example, we go from an uptrend to a downtrend, those are the things that we look at. This helps us to understand the environment, these models that we look at. We use other tools to help us determine, okay, are things still looking positive, or are they switching over and turning more negative? What are you going to do? If you have only long positions, meaning that you bought low with the idea of selling high, are you going to hang on to those positions? Are you going to sell some of those positions if things do change? Are you going to get into stocks that tend to behave better, if not perform well, when we are in a downtrend for the stock market? What are those investments? Do you even know what those are? These are things that need to be thought about now, so that when that time does come, and it will come at some point, you will be ready. If you only invest on the long side, that means that you are defensive when we actually do change. Right now, you're offensive because the overall trend is up. Well, if you're still only in long positions and we're starting to head lower, now you need to become more defensive. Are you going to implement some kind of hedging? There is insurance that you can put on your portfolio, if not individual investments. Do you know about those? Do you know the different alternatives that you have available to you? When things are still going up, that is the time to plan. You can't buy fire insurance when your house is on fire. You need to buy it before you have a fire in your house. If you do, in fact, participate when prices decline, where you might get into short positions, or you might take advantage of mutual funds or ETFs that are inverse, that actually increase in value as prices go down, then you are more offensive. You're actually taking advantage of prices going down. So there's an offensive approach that you can take and a defensive approach that you can take with this, or a combination of the two. So thank you very much for taking the time to watch this video. I really appreciate that. Please click a like or dislike. Please leave any comments. Consider subscribing to this channel. That'll really help things grow and have more people see these videos. Please access the free workshop that I talked about at the beginning of this video. There is a public Facebook group that you can join, and I do have a blog at spxinvestingblog.com where I post articles that pretty much talk about the same things that I cover in these videos. So with that, thank you very much for watching, and I'll talk to you in the next video.